Well, listen, it's showtime, so let's just get with it, I suppose. And the with it today is, on the heels of that estate planning talk, thought it would be a good time to do. Sorry, it's tough this way to do insurance reviews as well, and insurance reviews like life insurance primarily, not P&C oriented. And for most of you guys that have been around for a while, you remember kind of the life audit days that all the large brokerage firms used to push. In theory, I think that had a lot of swagger to it and a lot of integrity. But I think that in practice, it was really just a masked way to replace policies. And if you recall from way back, digging in your brains from the days when we used to have guests from Florida or Ash Brokerage come, that was their kind of main theme was, oh, do this audit. It's, a real deep analysis and amazing how most of them need a new policy. So that said, there are times when new contracts make sense. One large client our team is working with right now is taking it upon himself to go and rearrange his insurance portfolio. It's like a $40 million estate, a lot going on. My point is change isn't always bad. So what I thought I would do is from the perspective of the financial plan. And remember, I'm primarily talking the financial plan as in someone just wrote you a check to give them objective advice on, call it, all the moving parts in their financial world. And of course, I'm worried about those that didn't pay you and you don't have an agreement to provide that. The question is, are you still required to provide that level of advice on those matters? And again, the answer is, if they think you're their financial planner, the answer is yes. If they don't think so and you're just doing whatever for them, well, then the answer is no. But I'm working this conversation on the presumption that this is a client that expects advice from you, and or you're looking to provide that kind of elevated experience to really make sure that you're fulfilling your obligations, let's say, as the personal financial head coach. So, and again, Cami dug up 5 quick steps for this stuff that came off of, I forget, one of the FP sites, but I'm going to focus on the back half of that. The first part is, again, client goals and objectives, and define the need. How much insurance do they need? And while that's pretty easy for you and I, it gets a little muddy later on in life. So for example, this client that's rearranging his own contracts and policies right now had a fair amount of life insurance, and the cash value was really envious. It was good. And it was gushing along at like a 4%, at a dividend. All of a sudden, it's a 5% cash on cash return. And really, you have to look at that and say, well, where the heck else, where am I going to do any better? But here's the problem. When you have a large estate and you don't need the income, the agents will sell that as, but look at the wonderful income stream it'll provide to you later on in life. Right. Well, what if you don't need that income stream? That death benefit is going to be taxable because it's not a good asset to get out of the estate, in that there's no leverage. If you have $10 million of death benefit, $6 million of cash value, that sucks. You're using up $6 million of gifts to get $10 million out of the estate. Whereas in a traditional estate plan, it might be, $200,000 a premium will get you that $10 million outside of the estate. You don't have to use up $6 million of good hard cash. So again, even the best contracts that are performing well, sometimes they're just kind of misfits in the current environment. So as that relates to the needs, again, the needs are the traditional death benefit, what happens if so-and-so dies, but then maybe that need shifted to estate needs, to whatever. So I think a healthy contract still needs to be looked at in light of needs. Now let's move on to in the traditional financial plan. So again, first you're figuring out how much they need. Next is what do you have? Then what should you do? And the what do you have part is probably a little bit more work than many people, other firms like to give it. But in the term sense, it's pretty easy, right? So if you have a client that has a big slug need, big term insurance policy, pretty easy to say that generally speaking, that may fit the bill. But then the question is, well, number one, is there a better deal out there to be had? And oddly enough, sometimes there is, as the mortality rates have come down. Now, I'm not that active in the insurance business, and my hope is to frankly get out of the life insurance business for me personally. But I hear inklings from people that are insurance people that premiums may go up, and that insurance companies are perhaps adjusting their costs because the income side is not meeting their objective. You know, when they priced their policies last go round, they expected X% on their treasury portfolio. Well, today that X% is 200 bips less than they forecasted. And I think that makes sense to me that that could equate to premium increases. Another situation. So you have a client, they have a need, they've got that need met. And let's say it's a 20-year policy or a 10-year policy, and they've only got 2 years to go. Now, this is a really gray area and a high-risk area, in my opinion. If they still have the need, and that need will extend beyond the term period, you've known from experience that sometimes that premium is going to spike. You know, year 11 or year 21 could be 2x, and that trajectory may continue over a period of time. So in that case, you might be well advised to, frankly, get another policy, and even though you're going to pay more, but lock in the next 10 or 20 years, whatever term you feel like is appropriate or kind of what is needed. So then the next part about a term, looking at an existing term contract, is it convertible, and does that matter? You know, converting to a permanent policy for some people, why would I do that, right? If you don't need the death benefit. But I'll tell you why you might do that. As in the case of a 52-year-old client that we have who had a life-threatening series of strokes years ago, he doesn't remember that his kids graduated high school, and it's been 10 years ago. They're out of college. He still thinks that they're kids. This guy doesn't remember what day of the week it is. It's like Groundhog Day every day for him. We actually just converted his SBLI term policy to permanent. He had a year and a half to go. So actually about a half a year left now. So it just got converted literally within the last month. So there's a reason why converting might be important. So your client that has 18 years of a 20-year policy is thinking right now, I'm not going to convert, no big deal. Well, you can't guarantee that that's no big deal. So again, that might be something you'll look at. And then if you have an existing contract that is convertible, do a little homework, because sometimes some companies will limit what you can convert to. So they will say, oh, you can convert this to product X, and product X is a dog. They haven't sold it in years. They only leave it open for purposes of this. People that need coverage, need to convert, they kind of got you between a rock and a hard place. So another point to look at in the term coverage is convertibility. I think strength of carrier is always important, but it's less of an issue now because most companies are owned by other companies. And if you look at the, term quotes now, within the top 30, there's plenty of highly rated companies. So it might be some of the other moving parts, the duration, the convertibility, et cetera, that may take a precedent or higher priority in figuring out what's the right contract for you to own. Okay, any questions before I just keep rolling on here about term reviews, defining the need, understanding how that need changes? And it's our job to anticipate and foresee those changes and bring those, kind of issues to the client, let them know that's why we think about this stuff. Any questions on the term stuff?
John, when determining need, do you use the Wealth Vision tool, or is there some other benchmark you use besides that?
Yeah, we've been using eMoney. We don't use Wealth Vision anymore, but we've been using eMoney. And, this is one area that there's so many good calculators anywhere online. It's such a really simple calculation because it's just a discounted cash flow of future needs and assumptions like inflation and interest rates, et cetera. So I do use the one in eMoney, though.
The eMoney gap analysis report is great.
So there you go, direct from the eMoney mouth himself. All right. Anything else on term reviews that you have a question on, or that I missed, or that you'd like to bring to our attention? Actually, let me think of one other. And that is, right now it's pretty common for people to convert their policies to something permanent that has long-term care riders. I guess for some, that's a more attractive alternative than long-term care insurance. I'm not a fan of either, but where they're appropriate, they're appropriate. I guess what I understand is if you have a policy that's convertible to a permanent policy with a company that offers long-term care rider, that you'll have to re-qualify for that long-term care rider. They won't just give it to you. So they won't convert your existing term to a new permanent UL with a long-term care rider. So that's going to be underwritten separately. And for that, they're not looking for dreaded diseases. They're looking for arthritis, osteoporosis, things like that, that keep, obviously dementia, things that keep you alive or don't necessarily kill you, but could make it a very expensive disability. So another thing to consider on when you would switch out if that kind of long-term care rider is in your future. Alrighty, so let's move on to the juicier ones, and that is permanent contracts that you run into. I never thought I'd say this, but 30 years later, geez, I wish I bought that damn whole life policy that these guys were trying to jam down my throat. Because at the time, the rate of return was 6 or 7%. We looked at the minimum at 4 and laughed out loud like, ha, 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 who would ever own this at 4%? Well, oh my God, my grandfather was right. How times have changed. So those old whole life policies with 4% plus are like better than savings accounts today. So when I look at those, I do want to form, as in all policies, permanent ones, we do want to see an in-force illustration. So that's the first thing and the hardest thing to get. Here's why it's hard to get. Most companies won't just give it to you. They will send it through the agent. So if it's a good company like Northwest Mutual, Mass Mutual, New York Life, they will make you go through the agent to get that stuff. And the agent is going to then call the client and say like, hey man, what's going on? Why are you calling them? I could do this for you. But meanwhile, all that agent tried to do was sell the client a new policy every year. So point is, what we try is get on the phone with the client to the company, and then the client introduces us. As I'm with my advisor, they'd like to talk to you about some of the analytics we'd like to see about our policy. And again, those analytics are, we're looking for internal rate of return on death benefit, internal rate of return on cash value. Now, what's interesting is in a new illustration, it's a snap to get those. And it's an ordinary part of the illustration, although you've got to ask for it. They don't ordinarily just give it to you. You've got to ask for it. But on an in-force illustration, that's really challenging to get those two numbers. So Tom, what would you say the odds, how successful have we been ever getting that stuff?
Getting them direct from the carrier?
Yeah.
It doesn't, it's less frequent, than you'd want. But sometimes you just have to ask, they'll send you illustrations. If you ask for the IRR, they'll send it then. They'll leave it unless you specifically ask for it. Calculating IRR is very difficult too for what you're trying to do with that too.
So what we've done, and we know it's not 100% accurate, is if they can't give us the IRR numbers, we'll get the illustrations, the in-force illustrations, and then just input the numbers into an Excel spreadsheet and have them drop out. And all illustrations come with the minimum guaranteed, blah, 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 usually 2, sometimes 3 columns. You should factor them all in. I think that's an important part of the, buy, sell, hold decision for life policies is that existing in-force illustration. Gets a little complicated when you have loans, split dollar, or any other things that have happened, because with those kind of encumbrances on the policy, you're limited in your options about what you can do with it anyway. But I still say you need to go through that basic premise of assume there's still the need. Is this policy a keeper? Here's what these illustrative points look like. And for the most part, I'll say this. If it's in universal life policy, that's probably between, say, pre-guaranteed UL. So let's say between 8 and 20 years ago, there's a high probability it's a piece of junk and it's not going to work because they illustrated very high interest rates, fairly high mortality costs, and those contracts often are still on a path to implosion. But if it's a whole life policy that was issued, say, 10 to 20 years or longer ago, it's probably okay. And the further back it was issued, it's probably okay. Now, it may not match the death benefit need, because you recall the, Northwestern guys, their mission was to sell you like $100,000 policy every year. So in aggregate, unfortunately, that client that's been a victim of Northwestern sales policies is probably got $900,000 whole life policies. Maybe near the end he tweaked them up to 250 or so, but they just stacked those policies one on top of the other, and unfortunately that is 8 times the amount of work for you, because you now need 8 illustrations, 8 analyses, 8 IRR calculations, where you've got to make 8 independent decisions. Now, for the client that's kind of had enough, and all this guy wants to do is sell me another policy, who's really eager to get the independent advice, that's a dream come true. That's a client for life, for sure. But if you haven't set the stage properly as the planner, the head coach, and kind of the guy running the show for the client, that might be a little bit more difficult if he views you as competition to the, let's say, the Northwest guy, or vice versa. The Northwest guy views you as competition to him. I don't see too many variable life policies anymore. Have you guys run into many VULs in the last several years? No? Yeah, good. Neither have I. Most of them already went their course of implosion. Of course, yours truly still has one, though. And I've been treating it like term insurance and paying the bare minimum amount every year. And what's interesting is, looking back on it, I guess I wish I pumped it up with cash, but not really, because at the end of the day, what I'm paying now on an annual basis is less than I would pay for the equivalent amount of term insurance. So it's actually worked out okay in that regard. If I were intending to keep it for life, it's probably going to be a little expensive. But nevertheless, I did run the numbers, and I have an Excel spreadsheet on my own policy that shows if I invest, this amount per month, how long does it take me to get up to the death benefit? And I think it was a long time. It was a long, long time. So it's still, again, analysis like that, one might still counsel that client to keep the policy. Just keep it, because you're not going to, unless you live to 110, which I'd say odds are off for me on that one, that you're likely to get a fairly decent rate of return on those premium dollars. Okay, so on the permanent stuff, illustrations, IRRs backed by the need and the changing needs and changing circumstances. If you are approaching this purely fiduciary wise, maybe there's a possibility that this will help you identify a life insurance agent that maybe you can work with going forward. But if your intention is to continue to sell insurance, fantastic. This will uncover opportunities, no question about it. And at some point in the future, I don't know exactly when, it's going to be a little bit more stringent, the rules, that is, about disclosure. Today, if you're a CFP, the rules are pretty stringent about disclosure. Same thing with the CPA PFS. And I think everyone's been somewhat relaxed about that, but I think that that's going to tighten up over time. And I mean, it's probably tightened up already, but I should say the supervision of it and the enforcement of it is going to get tightened up. And I think that's a good thing for the profession. So as it relates to using third parties, so Pinnacle, for example, I like Pinnacle. There's a lot of really smart people there, but I think that they are often approaching engagements like this with the hope, and they're going to do what they can to prove that a new policy is the answer. That scares me a little bit. So I say, feel free to ask for the advice, but take it with a grain of salt, especially if all roads lead to, 1035 exchange. As it relates to, wait a minute, where was I going with that? Shoot, it was still on the consulting vein and using third parties.
Third parties.
Yeah, it was all about the third party thing, man. Oh well. Boom, gone. Oh, it's back. It's back. I've had some very interesting experiences with some of the advanced underwriters at the companies. So this one client that in particular I was telling you, who's taken it upon himself to rearrange his insurance portfolio, is actually working with the advanced markets guys at Mass Mutual, and specifically at the Mass Mutual agency in Boston. And they've actually been really good at the kind of creative side and using up slats and other, estate documents that it would be the right way to own this, a little bit more than your classic irrevocable trust. And in his case, that's because he had so much cash value in some of those policies already. So I think some of the third parties literally at the companies are going to be more reliable than the ones I've found out in the brokerage world. And again, same grain of salt though, of course, because they'll want to input their company's stuff in there. But nevertheless, it's just another source. And it probably doesn't hurt to have 2 or 3 different opinions on matters like this as well, especially if they're significant. So the accountant in everyone right now is looking back saying, holy crap, this guy just like ran up 14 hours worth of work for me on this little financial plan I just charged $2,500 for. Correct, I did. So therefore you either have to charge more or earn less. It's your call. But shortcutting it is not a good idea, because this is the kind of thing that could come back and bite you in the butt. And if it bites you in the butt, it bites me and George and Gary and Bob and Tim's iPad. I like that name for you, Tim's iPad. So I think that's pretty much what I wanted to cover. Any questions, any thoughts, anything you wanted to hear that we could jump into?
So, hey, John.
Yes, sir.
Just, I guess, a fairly general question. I mean, how do we bridge the gap of advice then when it comes to, giving an insurance recommendation where, we've got this group like Pinnacle who we sort of as this independent GA, access to, hundreds of insurance carriers,
Yep.
versus our role is to provide this sort of this objective, conflict-free, recommendation. How do we get there? Knowing that we're trying to rely on by just trying to sell shit.
So that's the question. I mean, so restate that question again for me. Are you trying to, so do you want to be involved in a sale or not?
No, not
right.
Really.
Right.
I don't have an insurance license, so I don't really care. But we, as part of the financial plan, we do insurance reviews. So
yeah. So I'd say that you probably should find yourself a good agent. This is an opportunity to squeeze Todd a little bit, and maybe help him find a Northwestern guy that you can send some business to, or if they're willing to kind of reciprocate back on the other end.
Yeah, but doesn't that just put us back to square one? If I go engage with a Northwestern agent, he's going to sell Northwestern shit.
Not always. Not always. You're still the fiduciary. That's why it's a 14-hour thing. And what's interesting, this is really a great question, George, because I've got one complaint on my record, and that complaint is that I gave the advice as the planner. You need to go buy insurance. Bought insurance. Insurance agent screwed client. I was named in the lawsuit. And where I was deemed to be at fault under the CFP board eyes was that I didn't ride shotgun all the way, including the issuance of the policy, to see that what was issued is what was applied for. And that's where the agent kind of screwed the client, is he kind of switched policies. And this was a client that was supposed to buy a $600,000 single premium policy back in the days of a state exclusion of $600,000 for a $2 million death benefit. He was about 75, not in great health. The agent came back, took the $600,000, got him his policy, but picked a dividend option in a variable policy that let the cash value grow, and you're adding in the It's increasing the death benefit by the cash value, and it required $150,000 a year premium. I'm like, oh my God. So you're right on that it's a high risk area and it's going to take extra time. So where I was deemed to be at fault was didn't ride shotgun all the way to the end, even though the agent should have, and it was the client's responsibility because I was the guy that schemed up the idea of how to utilize unified credit for your two nephews in the days of a $600,000 exclusion. So it's going to take time. It's going to take time, and that's back to maybe choice of client. If you conclude, you know, this is going to be a 20-hour job, just the insurance alone, I need like $5 or $6 grand for that. The right client's going to like not even bat an eyelash, of course, but most of the ones that we deal with, that middle market millionaire next door guy is not going to like that. But again, when you're dealing in the 10, 20, $30 million level, that's insignificant because the premiums are six-figure premiums. And if you remind them that the agent cashed a check, if it's a Mass Mutual Northwestern, of about 82% of that premium, they'll all of a sudden realize that, oh, 82 grand versus 6, you're cheap. You know, and it's worth it. It's worth it. So that's more of a posturing conversation. And like anything else, it's definitely going to take you a lot longer the first few times around than it will as time goes on. And the trouble is we don't get a lot of at-bats in that arena. You know, maybe 5 a year, maybe 10 a year. So it might take a couple of years to develop proficiency and have that professional network where you feel comfortable and that you can rely on them. So great question, though. All right. Only skeleton I got in my closet, and you found it, son of a gun.
I found it searching through my own closet, John.
All right. Good question. Anything else? No?
I'm just wondering if anybody has had any issues with Pinnacle, John, along the lines you expressed some concern about, that they might just be looking for, you know, a sale or an exchange or something. What's everybody's experience been with Pinnacle so far?
I've never found them overly salesy or pushing you in a direction. I've had, again, I like them. We'll continue using them. I've found their follow-up sometimes to be slow because what they're doing, and for basic stuff like term, they're literally doing pretty much the same thing we're doing. They have a dashboard online with all their carriers. They see what step they're at. They'll ping me and say, hey, we're at step 2. Reach out to the client. They're helpful, and they get their word gets through the carriers immediately. But they can't do much without an assistant or the advisor themselves. It's just a lot of back and forth. This is where we are, instead of going, and it's a face and name that instead of one of the thousands of carrier representatives on the phone.
They're not salesy. I agree with Schulte. They're not salesy, but you've got Pinnacle, you got the insurance company, and you got us. You got a lot of people dancing here, and sometimes the communication's lacking. Like, we just literally wrote 2 policies for a husband-wife, and I didn't even know the client had been approved. So sometimes they don't do a good job keeping us in the loop. It's nothing intentional, I don't think. It's just logistics. And these aren't $25,000 permanent policies. These are, $1,000 to $3,000 term policies. So I get that we're not getting, white glove service on those. But it's just communication. You got to ride it. You got to be more proactive than I would like. But definitely not salesy.
So Gary, I think my comment, rather than digging on them, was just in general, that whole life audit concept that Ash pioneered, I think was great in theory, but in practice, it turned out to be much of a replacement conversation, at least through the channels I've seen in the past. So I'm glad that Pinnacle's able to provide some help. And, again, to Rick hit on it a little bit, we're doing small contracts. There's not a lot of big premium dollars flowing through our group, because we're not out there looking to sell stuff. Realize that Pinnacle, let's just say they get 1,000 calls a day, 998 of them are for people looking to sell stuff. So just, understand where they're coming from. They hear you call, they just presume you're a life agent looking to sell stuff. They don't understand the advisor, fiduciary. They really don't understand that. If you get high enough up in Pinnacle, yeah, of course they understand that. But even then, their core business is providing back office insurance services for large organizations, of which we ain't. But that's their model. It's just like Dash.
We just finished up a disability project, and that was fantastic. They were great. It's a completely different team, but very responsive, go through every step of the way. In this case, he was a vapor, so he still was getting a tobacco rating, but we digged into exactly what he's going to have to do to get away from that rating. So that's helpful. We did reach out to Kip from the summit at one point, because I remember him saying, reach out to us with specific situations. We know which carrier to go to for a 50-year-old male smoker, or, this really specific case. And I was upset with that because I reached out to him. He didn't have he's like, well, put it into the term calculator, preferred smoking, cheapest one's the best. It wasn't like, I thought it was very tailored. This company does this for this situation. But,
and again, unfortunately, that's the kind of typical sales line they give. But to the defense of the sales guy, companies change so goddamn frequently. When you represent 100 or 200 term carriers, it's really impossible to know who yesterday cut this requirement or added that requirement, or it's impossible. So that's why whenever I did do life business, I would always let clients know, okay, you did that, whatever. I don't even know what the application process is. Come back mortgage, and in fact, you do that, you're covered at least for any lapses of attention.
You're breaking up, John.
Sorry about that. I had to open my door because I felt like a little kid left neglected in the car. It was bad. Is it any better now or no?
Not much. Maybe you're getting low on battery.
Okay, well then I'm going to get out of here. Internet reception is my guess. So Candy, I'm going to bail. You guys can finish up the conversation.
Sounds good. Thanks, John. Have a good dentist visit.
We're trying.
All right, guys. Well, this meeting is recorded, so we'll have a copy of it up for you to take another look at, and I'll try to put a little summary together for you as well. Did anyone have any other questions, or would you like to continue a conversation with each other on this or anything else?
Yeah, I just wanted to, Tom Schulte had mentioned working with Kip Kaiser, and I was going to follow up on that because he was at our summit, as Tom said, last fall, and seemed to be, interested in working with us and helping us out. And I just wondered if anybody else, I think I had a conversation with him probably shortly after that, maybe before the end of the year. And not that it didn't go anywhere because of him, but because of the client, it really didn't go anywhere. But only really had that one experience. He, I don't think provided, this goes back to Tom's comment, quite the same maybe detail or flavor to what he was recommending versus Pinnacle. And though it's been a while since I've worked with Pinnacle, I had some life insurance cases maybe a year and a half ago with three brothers, and Pinnacle was great. helping us decide who to use and why and so forth, and stuck with it right to the bitter end, and one of which just took a while to get through. But I was just curious whether anybody else had worked with KIP and what their experience was. Anybody else? No.
Doesn't look like it.
No.
I've had good luck with, I believe his name's Robert Lamone. We might have met him at summits past, but he's still good. He's, for more complex cases, I'll go to him. He's at the very least a good starting point.
Okay.
Who's he with, Tom? You talking about with
Pinnacle.
LPL or Pinnacle? Okay.
No, he's Pinnacle, but LPL insurance isn't bad too. So you could use both and kind of bounce your thoughts off each other.
Mm-hmm. Okay, great. Anything else, guys? All right, well, have a great Monday, rest of your week. Good to see everybody.
You too, Cammie.
See you guys.
Talk to you next week is BlackRock, by the way. So that was a topic on big data that I guess they had brought up during last webinar that we held with them back in June, I think. So they're going to expand on that a little bit more. So that's Monday's topic coming up. All right, great. Thanks, guys.
Thank you.
Bye-bye.
Bye.
Bye.